Gresham College presents Darwin and Derivatives, 19th Century Insights into 21st Century Finance by Charles Taylor.
Gresham College was set up as a result of the 1579 will of Sir Thomas Gresham to provide free education for those who live and work in the City of London. And here we are, still interpreting what that means over 4 centuries later in 2012. The range of issues with which education should properly be concerned, divinity, geometry, astronomy, physics, law, rhetoric, and music, has been extended over the centuries, and since the last century, commerce, and all that goes with that, is an additional focus for Gresham College. Of course, the city has in part moved geographically here to the Docklands, so Gresham College has come with it. We host a number of events in the Docklands, but the premier event for us is the Sir Thomas Gresham Docklands Lecture, which we launched in 2004 with Sir Callum McCarthy, then head of the FSA. We are very pleased that this Sir Thomas Gresham Docklands Lecture will be given by Charles Taylor. Charles is an old friend with a distinguished background that is outlined in your program. Although originally British, Charles has successfully worked in the USA for a number of years and attained a very senior position in the US Treasury as Deputy Comptroller for Capital and Regulatory Policy at the Office of the Comptroller of the Currency. May I ask you please to welcome Charles Taylor.
As Michael mentioned a year ago, I joined the Office of Comptroller of the Currency. It's my first experience of being a bureaucrat, and in America that comes with the responsibility of saying, before you speak in public on anything, that these are my thoughts and not necessarily the thoughts of my agency or the US government, though I should perhaps say not yet. With a bit of luck, we'll get there. I want to use my allotted time to talk about evolution and the financial system. My thesis for the evening is that Darwin's theory describes the financial system very well. And that fact has far-reaching implications for how we think about regulatory policy, including, of course, since it's in the title, about what we do about derivatives. Darwin, as I'm sure you all know, thought of evolution as the process of reproduction, mutation, and selection. Local environments differed, and the adaptation of creatures over time produced different species. He understood that mutation took place during reproduction, but I don't think that's of the essence. Any mechanism of change that is subject to selection will do. Fundamentally, evolution is an algorithm for changing populations that works when the environment is changing and resources are limited. It happens locally. There's some local process for creating new population members. Variation is local. That variation is random and usually small, but sometimes large. It can occur among new entrants, as Darwin thought, or old population members can change and adapt, which was the idea that Jean-Baptiste Lamarck had about 50 years before Darwin wrote The Origin of Species. And then there is, of course, selection, which is also local. This fundamental characterization of evolution is powerful. For any population where change is local, there's limited variation and there's selection, and the environment is changing and resources are limited, many things can be explained. We can explain the emergence of diversity and specialization, cooperation and competition as survival strategies, co-evolution between species or specialists, networks of interdependence, and the progressive development of complexity. Now, it's not hard to see that there are populations in the financial system that evolve in this fundamental sense. Consider the population of financial institutions. The technological, social, and economic environment is always changing. Resources, people, funds, and market access are limited. Change is often local. Innovations are usually made within individual organizations and in response to very particular conditions that may not be local in the geographic sense, but are usually local in the sense of pertaining to a particular market or organizational need. And at least when governments don't intervene, there is selection. Evolution's at work when financial firms innovate and adapt on the run, and it's at work when firms don't adapt and then fail. You might quibble that innovation isn't random, but is instead purposeful. I hope that's true, at least. But the process of innovation itself is a combination of two basic processes of spawning ideas and then testing them. The idea generation stage is often close to being random. Then the testing stage is a process of selection, either actual selection by the marketplace or selection by more senior managers trying to anticipate what the judgment of the marketplace will be. Evolution survives, I think, as a pretty good description of what happens to financial institutions over time. Mind you, institutions aren't the only population that are in the financial system and that evolve. So do processes, products and services, trading portfolios, and business strategies. You may remember a famous book by Richard Dawkins called The Selfish Gene. And what he was saying about nature was that you should think of the genes as competing for survival and evolving, and that they use the organisms of which they were a part as the vehicles for that survival and for that competition. In the same way, you could look at trading strategies, for example, evolving and using the institutions where they're executed in that manner. There are aspects of evolution in the financial system I think that we should welcome. It delivers variety and choice. From diversity can come stability in the face of exogenous shocks, and diverse strategies can mute herd reactions. From adaptation comes innovation, relevance to changing needs, and values for the many customers of the financial system in the real economy. And if the alternative to doing that is central planning, or as a way of accommodating social, economic, and technological change, I would rather have evolution. But there are other aspects of evolution that are less benign. While diversity may enhance stability in many situations, ecologies do collapse from time to time. In evolution, equilibrium is punctuated. Highly networked and complex ecologies can grow especially vulnerable to collapse because evolution can drain out adaptivity during periods of quiescence in favor of efficiency. From the public policy point of view, where we want the financial system to be is that it should be efficient, fair, and stable. Evolution may deliver efficiency as well as anything else can, but it needs constraining if it's to be reasonably fair and stable. So from an evolutionary perspective, shepherding evolution away from unfairness and instability is the basic purpose of financial regulation. Let me now turn to the implications for policy. And what I'm going to do is discuss 6 ways in which the theory of evolution could be relevant, and then make some general concluding remarks. And I'm going to start with over-the-counter derivatives. As all of you know, I'm sure, what over-the-counter derivatives are is contracts between firms that are tailored to very specific risks. Since the 1970s, they've bloomed, and today they continue to be one of the most adaptable frontiers of finance, because the idea of a two-way contingent contract to make payment is an extraordinarily versatile risk transfer mechanism. As our understandings of risk evolve, I'm sure we'll need new OTC derivatives to manage them. From an evolutionary viewpoint, then, the current reforms aimed at encouraging the movement of derivatives to CCPs and registries look quite good. They leave the innovation frontier untouched. That is, more vanilla-style OTC derivatives will migrate, and those that are more tailored don't need to. They reduce the complexity of the network by centralizing counterparty relationships, leaning toward the natural tendency of any evolutionary system to grow more complex over time. They increase transparency and reduce uncertainty, which should be particularly helpful in times of uncertainty and instability. So fairness and stability should be served without diminishing diversity and efficient innovation at the margin. I think this is an instance of where evolution reinforces the established wisdom. Sometimes, however, it refines our established ideas, and sometimes it might even threaten to overturn them. And I think this is possible because there are some common elements between traditional neoclassical economics and evolution. Both work when resources are scarce, both involve competition. In the case of purposeful variation, both involve a calculation of costs and benefits before a course of action is adopted. But the established wisdom is also informed by old neoclassical theories of equilibrium, of markets clearing, of homogeneity, of perfect foresight and knowledge, and there is an underlying idea that all of this can lead to some kind of social optimization. Evolution, by contrast, is a theory that's much more concerned with change, with disequilibria, with the ebb and flow of variety across populations. It makes no claim to optimality. It's a satisficing rather than an optimizing theory. My second example of a way that evolution can refine the established wisdom is the thought that some failure of financial institutions can be good. Evolving populations need turnover to stay fit and healthy. The more traditional notion is that Schumpeterian cycles of destruction are inevitable, but they can be synchronized and disruptive in the financial sector. Evolution would suggest that for long-term and general stability, we should like to see turnover that involves an institution or two disappearing with some regularity. The established wisdom would say some institution failing is inevitable. The evolutionary perspective is that some institutions failing is desirable. The implication is that regulation should not really aim to eliminate institutional failure. Rather, it should be criticized if there are no failures at all. It's probably freezing evolution, and the cost will be paid at some point. There's a shift in direction. There's a shift in this direction taking place, of course, as regulators almost everywhere are adopting a mandate to think about macro-prudential as well as micro-prudential regulation. But there's still a public concern to hold regulators accountable for every failure and loss, which I think we can question from an evolutionary perspective. My third example of policy relevance, which may be a bit more revolutionary, is that the unthinking promulgation of best practice, even when in reality it is best, might sometimes be bad for the financial system. True, adopting best practice may improve the performance of many individual institutions. But if everyone adopts best practice in all things, a population will lose diversity. Carried to an extreme, our concerns about herd behavior become more likely, as does the danger of some change in general circumstances, causing not just one institution to fail, but many. From an evolutionary perspective, best practice run rampant could be problematic. Average fitness is desirable in an evolving population, but minimum fitness isn't, in and of itself, particularly important. Population members that are unfit tend to disappear, so low fitness at the tails of a diverse population is a problem that tends to take care of itself. Consider capital levels, for example. It's important to keep average levels for capital high to ensure general fitness among the population of banks through cycles and in the face of shocks. Minimum capital standards do ensure this, but they may come at the expense of some loss of diversity. A population of financial institutions that all choose to operate at the minimum to optimize against regulatory requirements, say, may be more likely to suffer a crisis synchronously than one where there's a similar high level of average fitness but more diversity in choices on the trade-off between investments in risk management, choice of business strategy, and risk appetite. A fourth area of relevance where evolution can be illuminating for policy is, I think, the current debate on principles, rules, and complexity. Rules aim at means as often as not, and principles tend to be more about outcomes. Rules run the risk of slowing down and sometimes stopping evolution. Detailed rules that may work in the short run, but apply to a complex adaptive system that is constantly evolving, there's the risk that they'll become irrelevant in the long run. Andy Haldane, who preceded me on this platform last year, recently gave a speech at Jackson Hole in the United States, where he called for a simpler approach to financial regulation, as we have an increasingly complex system, because simple forecasts and controls tend to work better in complex systems than complex forecasts and controls. So he drew a general argument out of the control literature, and by doing some economic analysis of forecasting and showing that complexity didn't mean an improvement. There can also be enduring, it also, I think, is that simpler can sometimes be more enduring if a complex system is evolving. Principles are more likely to be relevant. Take consumer protection, for example. The evolutionary perspective would suggest that there's one basic guiding principle, one outcome we're really interested in, which is that consumers understand the products that they buy. It's quite a good thing that there is a plethora of products and that they continue to evolve. They're serving customers and consumers, and there's a wide variety of needs out there. It may sometimes be a bit confusing, and there's obviously a case for strong disclosure to help improve consumer understanding. But the specifics of the disclosure are far less important and far less enduring, given that we have an evolving financial system and evolving needs that it serves, than the basic principle that consumers should understand what they buy. A fifth area of policy relevance is, I think, the importance of putting an added onus on supervision as opposed to regulation. The division here is between rules and regulations that are applied across the board, and supervision which can be more customized, which involves going in and looking at financial institutions and taking account of their particular circumstances, their business strategy, the risks that they face, and can be much more forward-looking. Supervision is needed to interpret principles and to ensure that they're applied. And, of course, supervision does help enforce rules as well, regulatory rules. But the basic strength of supervision is, in this evolutionary perspective, that it can accommodate diversity and it's forward-looking. Supervision is getting more attention nationally and internationally. In the US, for example, the Fed has new authorities under the Dodd-Frank Act to supervise systemically important financial institutions more intensively than they have been supervised to date. The FSB has set up a supervisory intensity and effectiveness group about 2 years ago, which is working on issues ranging from supervisory independence to resources and powers and the various tools and techniques that supervisors use. And the Basel Committee has just completed a revision of the Basel Core Principles for supervision, which is a primer on how to do supervision, which I recommend to anyone who's really interested. However, there's much more to do. Changing practices necessarily take a good deal of time. People have to be recruited and trained. Budgets have to be modified, and in some instances, legislation will be needed to be written and passed. We have to rededicate and redouble our efforts to get sound practices in place, and we need to do more to make supervision transparent and accountable. The sixth area I point to is incentives. Both neoclassical and evolutionary theories agree on the importance of incentives. Both theories expect individuals to engage in cost-benefit analysis before they select a course of action. Both theories call for aligning incentives with good social outcomes, with the fairness, stability, and efficiency that I mentioned in the case of the financial sector. Against many other sorts of policy intervention, policies that address incentives have the advantage from an evolutionary point of view that while institutional arrangements may change, incentives affect behavior in almost any conceivable future configuration of the system. Now, of course, there's been extensive official reviews of incentive compensation in the financial system in the wake of the 2008 crisis. There's been quite a lot of work done here, internationally, and in the United States. I'd note, however, that compensation practices are still a long way off from one important historical norm, that of the partner in an old-fashioned investment bank. Much of the reform effort has been focused up to now on looking at the incentive comp as opposed to the incentive effect of total comp. And what you saw in an old-fashioned investment bank was that partners received almost nothing but incentive comp. But they received it after a very long time. And it depended on the results and the performance of their institution sometimes well after they had left the firm. So they had an enormous interest, for example, in one topic that's important for supervision today, which is executive succession planning. They didn't really have to be told to worry about their successor if the quality of their successor was going to determine whether their grandchildren could have a good education. And I think that it would be good for us to bear that in mind for material risk takers in certainly the banking sector, and that includes traders and managers, so that they would truly internalize risk management practices and principles and think hard about risk before they took it. So I've got a few concluding thoughts. We've been talking about theory, and I've also talked a bit about the practical implications of policy. I hope I've demonstrated that they're potentially quite profound. We've looked at derivatives, institutional failures, best practices and how they can be sometimes perverse in their effect, complexity, supervision and incentives. But I think we've got a long way to go to develop those implications fully and to apply them to policy. Ideas have to be converted into proposals, they have to be discussed and agreed, and I'm finding out the hard way that that's hard sometimes to get agreement nationally and internationally. Data has to be collected, parameters have to be estimated, and transition periods designed. That's a long path to tread, so going from theory to practice isn't easy. At a practical level, we can't wait to strengthen the financial system. It's been 4 years since the height of the crisis. The reforms underway address many issues that are important and urgent from whatever theoretical perspective they are addressed. Capital had to rise, transparency had to improve, derivatives did need taming, consumers needed more protection, and resolution had to be put on a more orderly basis. We have to sustain these efforts to implement reform. But at the same time, we should be open to exploring new theoretical perspectives, just as we have to be alert to valid criticism from the industry, academics, and the press. And in an endeavour as far-reaching and protracted as the current reform effort inevitably is, it behooves the regulatory community to consider every argument on its merits. This includes thinking critically about the foundations underlying our accretive approach to developing financial regulation. I think we also need to do some practical things, beginning as soon as we can, to monitor complexity and diversity. There are some good one-off studies of complexity out there, but not very much at all about diversity, except for some of the work that's being done by Michael Manelli. Monitoring remains a very long way off, generally. We need to sharpen our understanding of this complex, dynamic system. We've got some efforts underway that are trying to lay the groundwork for that. One of them, with which I was associated in the United States and its foundations, was the Office of Financial Research. And there are other economic research efforts in central banks going on that are helpful. But I think these should be informed by this evolutionary perspective. So we face the difficult task of moving forward on two fronts at once, maintaining reform while we embark on a critical examination of what we have brought. I hope I've succeeded this evening in encouraging you to think that Darwin's perspective can help. Thank you very much.
Fantastic, and thank you very much for that, Charles. It's really quite refreshing to have the 19th century brought to bear. I have a couple of opening questions, if you might, and then we'll move to some of the questions that the audience has submitted. I just think it might help, because the OCC is very much a microprudential regulator, and could you just help the audience a little bit with kind of the distinction between macro and micro and why that matters?
Yes. Microprudential regulation is, when it comes to safety and soundness, traditional financial regulation. Macroprudential regulation is worrying about, microprudential is worrying about individual institutions. Macroprudential regulation is worrying about the system as a whole. So we know, or we knew, that there were things we missed in the way we were approaching microprudential regulation before the crisis, and much of the reform effort since 2008 has been geared at filling in certain holes in the way we thought about the safety and soundness of individual institutions. But there was a bigger issue that came to the fore, which was, I think, in 2008, the surprise that it delivered to almost every observer, that at the very core of the financial system, we could see a meltdown in which there were extraordinarily fast interactions between different parts of the system, and very rapid contagion and danger of complete collapse. So that thinking about systemic stability is now an important responsibility of the financial regulators in the US and here.
I don't think I've ever seen Darwin explained so succinctly. I think that was very elegant to get that off in just a couple of minutes. But I did find it kind of interesting. You know, Darwinian theory is basically birth, variety, death, and that cycle. And your 6 principles were excellent, but there was one that I was sort of interested in. It was the second one, where you talked about failure can be good, which I certainly concur with. We brought out, the Treasury and BIS brought out a white paper back in June, which was the government's response to the Vickers report. And in that report, they patted themselves on the back about something kind of interesting, and that was birth, which you didn't really cover. And they said, you know, what an amazing thing. Now there's virgin money. But when I look at the US, you know, we're looking at sort of somewhere between 5,000 and 10,000 retail institutions, and a vibrant birth market as well as death. Germany, I think, is sort of in somewhere between 1,000 and 2,000 retail institutions, and I think has a problem getting them going. But here we have 5 controlling 85% of the market. A quarter of the country is without a bank account because we're daft enough to bank a quarter of the country with one bank. You know, what do you have to say about birth?
I was afraid you were going to ask me what did I have to say about UK policies, but
we can get on.
I'm happy to talk about birth. No, birth is important. I think one of the limitations of evolutionary theory is that it works well on largish populations. Some of the ideas can work on smaller ones, so I think it is important that you should be able to kill off large institutions, even if there are just a few of them. And that's, of course, what all of the reforms around resolution planning are about. So this notion that large institutions should have living wills so that they can be broken up in a non-disruptive way. They don't have to be sold in the future to another large institution to make an even larger one. That's an important element of reform in various places. But you're right, the idea of birth is very important too. New entrants should be encouraged. It's the case, I think, in an economy and a financial system as large as the United States that a lot of that happens quite naturally. If we're talking about the banking system, we probably charter a few banks every month. And good times we may be doing a few every week. It's a fairly rapid process. And of course you get new entrants to other parts of the financial system quite rapidly too. It's one of the strange things about, which I haven't really worked out in my lifetime, is why the financial system tends to get so concentrated when financial markets are generally fairly good at moving information amongst smaller players. You'd think that the better we got at moving information and transferring risk and moving it around, the advantages of being big would diminish. But we do actually see quite a lot of concentration. We do see barriers to entry. And that's an important issue for us to address from an evolutionary point of view.
Okay. Well, I've exercised the chairman's prerogative of a couple of my own, but I thought I'd turn to some of the questions that have been submitted by the audience. This one comes from an ACCA member who is interested in, would you please comment on whether financial accounts at present give the most useful financial information for regulators and supervisors to monitor the risks posed by individual banks and the banking system? So is there anything you'd like to see? I mean, I say that obviously in the context that we've brought out a paper recently on confidence accounting, which is looking at representing ranges, so there's an element of that. But I also thought it was very much in line with your third point about best practice can be bad, so there seems to be a bit of a tension here. What are your thoughts on the sort of current state of financial reporting?
Well, what you really want to get at is our three themes: fairness, stability, and what was the third one? I had three principles that we were trying to go after.
Test the audience.
Somebody from the audience. It was fairness. You're going to make me look it up, aren't you? That's terrible.
You're a U.S. presidential candidate.
Oh no. Thank God I'm not that. What's really important, and one should never forget, is that what we want from financial regulation and from the financial system is a system that is fair, stable, and efficient. Thank goodness. And so what does disclosure help to do in that way? Well, there are two sorts of disclosure. There's disclosure into the markets and there's disclosure to regulators. Regulators actually get an enormous amount of information now. Certainly in the United States, but I think also here, there's almost nothing they can't ask for. The US has, since 1864, had something called the Call Report, which meant it was a report that the OCC could demand from any bank in the United States on call. They could say, look, tell me on these 10 or 20 things, and now these 2,000 or 3,000 things, what your position looks like today. And we do get daily reports on many aspects of most of the institutions we oversee, or many of the institutions we oversee, certainly most of the big ones. And it's an enormous amount of information. But what's the principle here we should be following? I think the principle is we should be looking to understand not so much the balance sheet or the income statement as the risks. And there, confidence reporting may have a part to play, but I think it's also important that we should think about the risks of the system as a whole, and we need to collect more data on the relationships between institutions. So one of the projects we have underway at the FSB, it started by the New York Fed a while ago, was to try and get up-to-date, reliable information on how much exposure there is from one big institution to another. You'd think this is something we would know today with great accuracy and precision, but we don't. And it's a major data gap, and this Data Gaps project has been going for a little while now. It's beginning to collect data, but we really are quite a long way from being able to say, if something happens today, what its implications might be tomorrow by looking at that web of interconnectivity. So that's one big gap. And I think the other big gap is around diversity and complexity. We don't generally track, we don't look very much at diversity measures for things like the portfolios of banks, what sort of businesses and business strategies they have, things that might actually impact how they behave, how much herd behavior there is in reaction to a crisis. We don't generally track that kind of information for non-banks either. And although they may not be so close to the heart of the financial system as the banks, still they can, as herd behaviorists, have a very major impact potentially on the way a crisis unfolds.
Thank you. I had a question. I get all these questions in, and I sometimes see that they overlap or have the same theme. So this is a composite one, which several professionals and 2 journalists asked effectively. And really, I think you're in an ideal position to answer it because they're really interested in the US view of London. So the question was, given LIBOR and AML scandals, plus London's reputation globally, finance professionals based in London have less confidence in London's future competitiveness than some European and Asians have in their home centers. A number of commentators think the US has it in for London. What do you think?
Well, we've watched this debate, of course, from Washington, and we've seen this public reaction in the United Kingdom, and we're in a way we're rather flattered, I think. You have to understand that there are several US regulators. We have 50 states. We have separate regulators for insurance, for securities transactions, for banking. We have 3 federal banking regulators. One of them is a federation of of 12 regional, rather independent regional regulators of the Federal Reserve System. And the idea that we would have some subtle coordinated strategy to do something about the relative competitiveness of the United States and the United Kingdom is, I think, suggests a level of coordination and attention that's actually quite hard to deliver in the United States. So I'm not, I don't think there's much truth in it, to tell you the truth.
Okay. I'm sort of interested, I had a lot of questions, and I think it's possibly an area of comparison between the US and the UK on quantitative easing. So I had a number of people, a CSFI member and a broker. I had a couple of people ask me who were involved with the regulators and accountancy. Basically, they were interested, possibly the most interesting of the questions I got was quantitative easing is creating money, which is simply being used to bolster bank balance sheets. If we take QE to its logical conclusion, a so-called Bernanke law, the money supply shall expand so as to fill the bank balance sheets available for their depletion, which I thought was rather amusing.
Well, I thought evolutionary theory was fairly radical, but I think that's probably even more radical an idea. I'm sorry, I'm not going to take the fifth exactly, but it's slightly outside my expertise. Mm-hmm. It's in, I think it's deeply into the space of monetary policy. And I'm an observer, a lay observer of that in the United States. And indeed, I do see Mr. Bernanke now entering his third round of quantitative easing. I recall reading Martin Wolf in the Financial Times saying, well, you know, it was an ethical thing to do and that we needed to have the alternative of not doing anything was worse. But Martin's conclusion was that the chances of it being effective were limited. Well, I suspect that Chairman Bernanke knows that and generally shares the sense of why it should nonetheless be done. But I'm now treading on very dangerous bureaucratic ground, so I shall retreat.
Well, I'd like to turn to possibly your fifth point, which was on supervision versus regulation. Mm-hmm. Back in 2009, in fact, I co-wrote a little booklet with Bob Giffords, which Andrew Hilton kindly published. And we considered in that 3 levels of government intervention in markets. First, ensuring competition, open markets, which you clearly encourage in this evolutionary approach. Then supervision, which we called knowing what's going on. You may disagree with that, but kind of with that. And then regulation or rules saying what's going on. How do you draw the boundary between supervision versus regulation? It seems to bleed so easily from I'm just asking for a few figures, but actually I'm telling you to I've written the rules and I can't be bothered to see if they're really being enforced. And I've seen both ends of that where the words don't seem to be clear, and certainly not clear, I think, on this side of the Atlantic.
Well, one sort of context-setting point to make is that the amount of resource we put into supervision is quite high, and that in my agency, the OCC, supervision is what we do. So we have a fairly, a very high commitment to doing it as well as we can. The relationship between supervision and regulation is that I think different people have different perspectives on it, but certainly one is that supervision is the way you enforce regulations. You go in and you check and you make sure you know what's going on, and you make sure that what you said was the regulation is being done. I don't think that's the end of the story at all. In fact, I'm not even sure if it's the most important part of the story. I think supervision is about really bringing a different perspective to what is being done in individual institutions. So it's about going in and asking lots of questions. Some of them are very loaded, but basically not providing too many answers. That's the job of management and of the boards of these institutions. But to ask questions about risk and to ask questions about transparency and so forth. Bearing in mind the story that they tell about what their business strategy is, what their business circumstances are, and to think forward about emerging risks so the supervisor can bring to the table an understanding of what is being seen across many banks, even across many different national banking systems. So the supervisor has the advantage of coming back to the OCC, in our case, and talking about risks that they see. And once every 6 months or so, we actually publish a report on emerging risks in national banks. And in between times, we're comparing notes all the time, so that can then help the supervisor go back and saying, look, you don't have a problem here yet, but have you thought about this? Or do you see this circumstance in your local market becoming more important? Or, have you got an approach for this? Have you stress tested your portfolio against this? So there are a lot of questions that can be asked, and it's really a question of what the supervisor is doing in that case is going very much farther than the backward-looking rules, the rules that are based on past experience, the rules that capture maybe how things should be right now, to encouraging and supporting thinking about risk in the future for an individual institution or an individual market circumstance.
Just looking at competition in a slightly different way, there's another interesting US-UK comparison, and that's about the regulators themselves. One of my favorite quotes in competition is screaming Lord Such's, why is there only one Monopolies and Mergers Commission?
Yes, good, I like it.
And for a while, in fact, we at least had the Office of Fair Trading and the Competition Commission, which are now being melded here. We've had discussions, and obviously we've moved towards we call it Twin Peaks regulation, but basically a very integrated regulatory system here. And yet when you look across the US, it's just a mess to a European of CFTCs, SECs, it just goes on and on and on. And everybody seems to fight these turf wars. Is the US a more diverse, competitive environment for regulators, where we can see better regulators emerging, and Europe is sort of too dirigiste, too centralized, and we're stagnating? What are your thoughts on that?
Well, there's certainly diversity of views in the United States on many issues between different regulators, and part of our challenge in implementing the Dodd-Frank reforms was that many of the reforms called for joint rulemaking. So we actually had to get together with our counterparts in other regulatory agencies and figure out common positions on how we wanted to do things. So that was quite a healthy process. We did see different perspectives brought to the table. It had the disadvantage of dragging things out a bit, perhaps more than we wanted to, but it did have the advantage of there being some give and take amongst ideas. The Federal Reserve supervisory leadership would tell you that they see the same thing amongst the individual members of the Federal Reserve System. The Federal Reserve Bank of St. Louis and the Federal Reserve Bank of Cleveland and of New York and San Francisco may not actually see eye to eye on things. They may do things in different ways. They may want to, for example, report on how they do supervision in different ways, so that the Federal Reserve Board in Washington, they see a good deal of diversity there too. Actually, I'm not sure quite whether this level of diversity within a nation is, or within we're a large nation in the United States, or a region in the case of Europe, is a strength, or it's something you just have to live with and work around. The more international competition you can have and the more international exchange you can have between financial systems, the more I think you have a chance to exchange views and to see some competition between regulators globally. So that may be, that's a source of this sort of competition of ideas amongst regulators. I don't know how many monopolies commissions there are in the world, but I suspect it's quite a few, or equivalent bodies to draw on. And certainly when you go to Basel and you see 27 countries and 40 agencies around the table, there are lots of views to take into account.
So you're not exactly a believer in international harmonization arriving soon, is that?
Oh no, I'm very much in favour of working for international harmonization and working toward it. I think that it facilitates globalization. That was a much loved word before 2008 and less loved now, but we get enormous benefits from international trade, and international finance facilitates that. So it's not as though harmonization is a nice to have. I think it's in some areas it's a must have. It's very hard work, and sometimes perhaps we should allow for there to be different national interpretations of regulations and rules. In fact, we do. But I don't think that we should give up on harmonization.
Your last point was touching on incentives, and the debate in Britain, I find, at least when I'm watching Question Time or listening to an article on Newsnight, seems to be very much that the incentives that are given to city workers are out of proportion and out of control. Do you have any thoughts on that?
Well, out of proportion to, I suspect that the public debate is more out of proportion to average levels of compensation in the country, and that's an issue of equity, and one which I think financial regulators, generally speaking, have trodden around lightly. And I'm not quite sure what the underlying reason for that is, but that's the case. The other question is sort of the composition of compensation. And up to now, as I think I was saying, there's been quite a lot of thought given to that part of compensation which is called incentive comp, and not so much to the total comp package, I think. So that the thought has been given to how much of the total package, not enough has been given to how much of the total package should be incentive comp. And if it has been given, it's tended to say, well, don't give too much as incentive. Whereas I think you can make a fairly strong case that you should give an awful lot as incentive, but it should be delayed and it should be related to long-term performance. Why is that the case in finance and not so much the case, let's say, in automobile manufacturing? I think it's because finance is a business of public trust. It's a business where it's, you know, if I buy a car and the car company fails, I've still got my car. If I have investments with an institution and the institution fails, I may or may not have my investments. And I have, as a member of the public or as a non-financial institution or as another financial institution, I need an assurance that everyone who's on the inside, who has the asymmetric information about a particular institution, is thinking about my interests and about the long term. And the best way we can do that, I think, is to say that they're interested in the long-term reputation of their institution. Many people are, of course, but I think that to date our incentive structures have tended not to pull people, not to date, but at the moment they don't push people as much as they might toward that orientation. I think they did in the old-fashioned investment bank. Levels of remuneration were high. No doubt they've failed the equity test today in many instances. But there was a tremendous concern with reputation and long-term integrity, because you didn't want to have to go and explain to your spouse why you would be moving in with your mother-in-law into the basement because you'd lost all your money. That concentrated the mind.
One of the things that I was interested in your very first point, you talked about reducing complexity, as I took it, and you used as your example there OTC derivatives and the central counterparties and the registries, and as a sort of a very, very good example of reducing complexity, increasing simplicity. I was also, though, sort of curious, how does that square off against perhaps introducing single points of failure? Or do you see that as a different problem?
No, it's a very good point. This is a sort of a network stability point. So in complex networks, when you observe that there are some nodes in the network that are very well connected to everyone else. If they fail, you can be in trouble. They can also be super spreaders for contagion. They can pass contagion around. And I think that's one of the things we saw during the 2008 meltdown. Contagion spread across these large complex institutions, partly because of counterparty relationships, but partly because they were rather opaque and complex. And there were many people in the markets who looked at the failure of one broker-dealer and then saw another one fail and concluded that all large broker-dealers were vulnerable. They ceased to make any distinctions between them. So being a large super spreader in a network is a potential source of instability. So what happens when you create a central counterparty and you funnel all sorts of trades and all sorts of transactions through it? Well, you do, in a way, increase the importance of that CCP. It does potentially become more systemically important than it was. They are a different kind of an animal. They have a particular structure of risk. I think it boils down to being some credit risk and a lot of operational risk. So they are a bit different from most financial intermediaries, which have a mixture of market risk, credit risk, and operational risk. So they present different challenges. And it does have to be taken into account. I think it is a fair point that concentrating more activities in central counterparties presents its own problems.
In a recent book I had to read called The Price of Fish, because I wrote it, but we made a big point that evolution, choice, and systems needed to be combined with economics. So I obviously have a tremendous amount of sympathy for evolution being really connected with the way that we view it. But I'm often reminded when I think about evolution of chaos theory. Chaos theory isn't so much a theory as a set of observations, and you can look at the world in a different way. But as a research field, it peters out pretty quickly. We have a lot of academics or academic connections here at Gresham College. Given your emphasis that we should be taking an approach that utilizes evolutionary theory, how might that play out in a research agenda? What should people be looking at? What should they be thinking of? What areas of research can help improve financial stability?
Well, I don't think it's easy. And I think your point is well taken, that evolution is somewhat more open-ended, less closed solution sort of a theory. It is highly descriptive. So the minus is it may be a little bit more difficult to do analysis. The plus is I think it's a lot more realistic than much of traditional classical economic theory. We live in interesting times from the point of view of theoretical developments. I think often in subjects you see an interplay between data, and analytical capabilities, money, and sort of real-world necessity. And sometimes you see these leapfrog one another. You see more data create a challenge to existing theory. So theory has to move ahead a little bit, and then that creates more demands for data. And if there's enough public commitment or private financing available, this progression can go through many stages. In the case of thinking about the stability of the financial institution, the financial system rather, I think it's early days, but we're actually looking at potentially a much larger amount of data, where I think also at a point where there are some promising mathematical strategies and analytical strategies to be looked at and exploited. So, for example, we're getting better over time at doing simulations of complex systems. They've been used to provide insight into systems which you can't provide closed-form analytical solutions for. So that's kind of a nice way of approaching it. You kind of run the system and see what happens. Those computer capabilities, those analytical techniques, I think, are getting sharper over time. And as we bring more data to bear, I think that we'll see this kind of incremental evolution hopefully carry us forward.
Two more questions, so don't fret. I'm just curious. We had a lot of frustration expressed in some of the emails that came in, and possibly one of the ones was a city IT worker who was really quite upset about, we're 4 years definitely, and possibly 5 years in some people's estimations of the length of the financial crises that seem to keep recurring. The regulatory evolution seems to be very slow. The question really was, are we just kicking cans down the road? What are your thoughts? What progress has really been made in 4 years? Lots of flights, lots of airtime, but what's been the progress?
Well, as I said, I think we have to make progress. We have to do two things. We have to be mindful of these sort of more fundamental issues and explore those and work on them. And at the same time, we have to move ahead with the financial reform agenda. So I'm sympathetic to the question. It has been a while. We've been quite ambitious. We have quite a few items on the research agenda, on the reform agenda. And in the United States, for example, I think we have over 400 rulemakings that follow from Dodd-Frank, and we're about a third of the way through of finalized rules. Many of those are the more important ones. There are some that are still pending, but we're getting there. There's a machine, it's grinding on. It's trying to achieve as much international harmonization as possible, and I think that's, as I said, very important. It's important that we do that. We are at the international level now, for example, in the Basel Committee, monitoring the implementation of Basel III. We've just concluded in the United States, or rather, the Basel Committee has just concluded in the United States a review of how well our new proposed legislation conforms to the Basel rules. That's the so-called Level 2 assessment. We have a Level 1 assessments that have been going on for a while, and they basically check that we're on time with our reforms. Level 2 assessments check that we're doing them right according to Basel III. The United States, Japan, and Europe, we've just completed all three of those reviews. And we're doing Level 3 assessments that look at how, when it comes down to the practicalities of doing things like calculating how much risk there is in banks, what the risk-weighted assets of banks are, that different countries do it in comparable ways. So we're actually working quite hard to implement and to oversee implementation of the reform agenda. Very important we keep at it, but I think we are making progress.
Okay. And perhaps we could just end on a personal note. It's fascinating with your background, US, UK. You've been working in the US since, well, long before the financial crises. Just what's it like for you? And also just sort of a question a number of students asked us. What does the future hold for Charles Taylor?
Well, thank you for asking. It's been a very interesting period. Since the crisis, I was lucky enough to work with an institution called Pew Charitable Trusts and to run a financial reform project there, which brought together many experts from academia and the industry. We produced a whole series of papers and reforms and workshops and so forth in Washington, working with Congress and working hard to achieve good reform. I think we had some influence on living wills. I mentioned those in passing, very important development, I believe. We had some influence on the creation of the Office of Financial Research, whose mandate really is to find out more about how the system works as a whole and to track the stability of the system. So I've had some involvement along the way in what's now on our plate. At the OCC, I have a portfolio of responsibilities that means I'm engaged in different aspects of the implementation of this. had a chance to think about some of these fundamental issues along the way, and I hope in the years to come I'll continue to be involved in both implementing reform and challenging it.
Thank you.
For all information, please visit www.gresham.ac.uk.